Today, I want to talk about one of the most exciting investment trends in Canada in 2025. And it's been all about Canadian natural gas and the massive potential of Canadian LNG. Now, this is a story that's being told all over the world, from retail investors here in Canada to Wall Street boardrooms to international companies looking for a source of stable LNG. And a lot of investors have started to notice that there is huge potential in Canada's low-cost natural gas producers, because these companies are built to survive the incredibly low prices that Canada's natural gas gets on the open market, and they have been able to make it through all sorts of crazy events while keeping their costs low, using really, really smart hedging, and just protecting their business. But now, with real investment coming into the industry, with huge $40 billion plus projects coming online, these companies are suddenly at a precipice where they could explode upwards. And investors don't miss opportunities like that. So we're starting to see some really huge bull runs in these companies, and I think there's huge potential to come. Welcome to Golden Arch Investing. My name is Liam. Today we're going to be talking about Peyto. It's one of these companies that I've talked about a lot on the channel because they are one of, if not the lowest cost producer of natural gas in Canada. They are an Alberta deep basin company. They are a fantastic operator, and they are renowned for their prowess at hedging, at being able to look into the future, see potential challenges, deal with market dynamics, and get the best possible price and the best stability for their shareholders. And they have been massively rewarded for that. Shareholder returns over the last 5 years are insane. And I think there's a real potential that the next 5 years could even dwarf that. With just a few things going right for this company, you could see real generational wealth made on a boring Canadian natural gas name. So let's talk about Peyto. Let's talk about what some really, really insightful analysts think about this company. Let's talk about what I think about the past 5 years and the next 5 years where I see the real potential. And of course, let's talk about the sort of challenges and opportunities ahead. We're going to start here. I've got a 5-year chart for this company. And this is a total return chart, which means it takes into account both the stock price and the dividend. And over the last 5 years, investors have made a killing, 881%. That's a compound annual growth rate of 57%. Now, of course, that is supposing that you bought right at the bottom, the middle of 2020, which in fairness, fantastic idea. And if you were somebody who looks for markets where there's distress and you buy in and you bought this company, you're probably a really intelligent investor and you probably made a huge amount of money. But just look at that run, 2020 through 2022. That's a 600% just about run, 580. There's another run from sort of the middle of 2022 all the way up here, which is again another 500%. Those two opportunities would have made you multiples on your money. And right now, there's a lot of smart investors betting on another. Now, if you don't know, the investment opportunity they're betting on is Canadian LNG. And we've talked about this lots on the channel. But the base idea here is that LNG will fundamentally shift how natural gas works in Canada. For as long as I can remember, the natural gas market here in Canada has functionally been, what is the weather like? When we have a cold winter, a hot summer, a lot of natural gas is used in cooling or heating homes. And of course, there's a lot of natural gas used on a daily basis for all sorts of sort of base industrial activity. But the big swings that you see in price typically come from weather events, and it's hard to bet on weather. That is not something that most really intelligent investors want to do. But LNG has the potential to really change that because LNG's demand is constant. You constantly need to be shipping natural gas to then cool it, liquefy it, and ship it abroad. And with LNG Canada coming online within the next month or two, there is a sudden shift to the pricing of Canadian natural gas. A big part of this is also removing the differential between Canadian and US natural gas. Right now, for argument, let's say if US natural gas trades at 4, Canadian typically trades at 2. A significant differential, a significant discount for these Canadian producers. with significant amounts of LNG suddenly being exported to global markets where they will pay a high premium, well, now that Canadian price cannot be so cheap compared to US because there's a lot more opportunity elsewhere. And so that differential might be cut down to about $1, maybe even more, depending on which expert you listen to. So that will fundamentally change the profit identity of these companies. The way these companies look at themselves, look at how much they can expand, look at how profitable they can be, look at the strategies they have to take will change. And it will definitely change for the better. Now, Peyto has been famous for their ability to manage risk. And I love them for this. It's one of the main reasons that I talked about them in the very first place, because they took advantage of the opportunity to protect shareholders against sudden events. In 2025, that looks like a genius move, with their hedging actually benefiting them more than the increase in natural gas price so far. Now, will that continue in the future? Nobody knows. But with management's consistent track record, I think we should give them the benefit of the doubt. I think there's real opportunity for these guys to take huge advantage of this coming pipeline of LNG projects that are already approved, being built. And of course, there's huge potential if we see more projects done, like the new energy minister, Tim Hodgson, has promised. Now, I don't think you should invest based on the promises of politicians, but I do think you should invest based on sound math and a good investment thesis. And to help you build one, I'm going to show you one of the best articles I've read about this company that helps explain what the next 5 years might look like. So the article I have right beside me is from a guy named Andrew Mach. We've read some of his stuff before. We've liked a lot of what he had to say. And as always, whenever I go through these articles, these are on Seeking Alpha. If you pay for a Seeking Alpha subscription, I strongly recommend you check out the article because the author absolutely deserves your support and you should click on their stuff. Now, the article here is titled Peyto Exploration and Development, Dividend Yield Might Double in 2 years. Now, as a dividend growth investor, seeing dividend yields shoot up is typically really exciting. But of course, the real story for all of us is total return. How much are you making in total? And with Peyto, with the potential for huge stock price gains, we could see some really crazy dynamics if we also see the dividend yield shoot upwards. So let's read through what exactly Andrew has to say here. If you're just looking for the summary, he says Peyto is a low-cost, high-margin natural gas producer, offering a sustainable 8% dividend yield backed by disciplined capital allocation and strong hedging. Absolutely true. Base case 2030 projections suggest a potential for 19% dividend yield by 2027, resulting from production growth and rising gas prices. Even in a bear case with sub $3 Henry Hub prices, which is like the US price, Peyto's strong balance sheet and cost structure ensure dividend stability, offering a margin of safety for investors. So this analyst is saying, Andrew here is saying, hey, even in a bad scenario, if you're a dividend investor, you need to look at this. And I agree. Let's go through the article. The North American natural gas market is shifting rapidly. LNG export capacity is quickly expanding. The LNG Canada and the new US Gulf Coast terminal is set to drive higher demand. At the same time, AI-driven data centers are pushing for higher electricity consumption with the need for reliable baseload power. I haven't even mentioned this because honestly, in Canada, that's not even what's on my mind. But think about that. If that draws power from the US grid, the US is going to power that using natural gas. Well, all of a sudden, now you need a lot more Canadian natural gas to replace that to keep the prices stable. Anyways, at the same time, oh, sorry, we're not there. Adding to this, oil prices have dropped to $65 per barrel, and if those decline further, oil producers will be less incentivized to ramp up drilling. This could lead to a reduction in associated gas production, further tightening the natural gas supply and pushing prices higher. This is a story we've talked about a lot with US shale oil. One of the theories about the sort of strategy of OPEC is that with US shale at this point where they've run out right now of their tier 1 inventory to drill, the highest quality stuff they could get out of the Permian Basin, they've been so efficient at getting at that oil that they're saying, hey, we're running low. A lot of major US companies are saying we got to cut back. We're a little bit worried. We've seen some like really notable figures in the industry, like the former CEO of Pioneer say, hey, we don't know. We don't know if there's going to be much of this stuff left, maybe a year or two before you have to start drilling stuff that's less efficient. And of course, that means that the break even, the cost to drill And then, of course, the sort of how much oil you get out of it, and then the price you have to sell that at to break even on that and make a profit is going to change. And it's going to change for the worse, as in get more expensive for those shale producers. So if, Saudi Arabia, OPEC and friends can sort of drive the oil price below that, well, all of a sudden these shale oil producers with these really, really quick decline rates are doomed. That was the idea back in 2015. It didn't play out exactly like that. So do not bet that, OPEC's going to drive US shale completely out of the market, but we shouldn't see a huge expansion in US shale in the next little bit, which means that maybe there's more opportunity elsewhere, or at the very least means that there's less natural gas just suddenly being pumped to supply all of this demand that's being brought online, which definitely benefits companies like Peyto, who don't have all those same challenges that their American peers do. How do you benefit from this trend? Sleep well at night and cash monstrous monthly dividends? The answer is Peyto Exploration and Development Corp. Let's explore how high dividends I expect with the current gas price futures. Let's project where the company can be in 2030, and let's finally let the bull meet the bear. I like this. He's having fun with it. Peyto Exploration. Peyto's built itself into one of the safest and most profitable natural gas producers in Canada. I would characterize the company simply by ultra low cost, high dividend yield, strong hedge book, and disciplined capital allocation. In my opinion, Peyto offers a huge free cash flow upside with minimal downside risk. Really well put. I don't know how much better I could put it myself. I think there's huge upside, and because they're so conservative, they're so protective, they hedge so well, there's not that much downside. There always is downside, but considering they're up 880% total return in 5 years, you would expect quite a lot of downside. I mean, most companies that run up like that have a long way down. But these guys, it doesn't look like they're going to follow that stairs up, elevator down trend. I think the downside would be just stagnation, really. Despite 2024 being one of the worst years for Canadian natural gas prices, Peyto delivered record production, kept operating costs low at 50 cents per million cubic feet. I believe that's what that is, MCF. I don't know if the E is supposed to be there. Maintained its high 8% dividend yield. As you can see, a lot came from Peyto's hedging program, which made them realize gas prices of 4.28 per MCF, despite AECO, which is the Canadian price, averaging week $1.40 MCF. It's a huge pricing advantage. That said, analysis is not about past results, so explore what the future has to offer. Projecting 2030. When making long-term projections for gas producers, we have to consider production growth, realized prices, cost structure, capital allocation decisions, and many other variables. Single most important one is the future gas price, which by nature is hard to predict. Thus, one has to think about probabilities. That's why I'm going to bring you 3 scenarios. Base case, gas prices and realized prices. Let me take you through the modeling of the base case, which works with prices close to strip pricing. So strip pricing is basically like you're buying sort of out. It kind of like a future. I think that's an easy way to think about it. I will work with the 2025 Henry Hub of $4 per MMBTU and 2026 forward $4.5 MMBTU. For the liquids, I use a benchmark of WTI of 65 per barrel. For the unhedged part of the production, I am using Peyto's realized gas prices at 68% of Henry Hub's prices, which I calculate as the average over the last 5 years. Further, Peyto is now hedged with 480 MMCF/D for 2025 at over $4 million cubic feet, 366 MMCF/D for 2026 at a similar level. That is at billion barrels per day, right? Hedging already ensures above cubic feet. I don't know why I said barrels. Cubic feet per day. Hedging already ensures above 850 million revenue for the year. Production growth and capital expenditure. Production growth isn't something you simply set as a target. It's a direct result of the capital the company invests and the efficiency with which it is deployed. Really well put. I think that is one of disciplined capital allocation. Smart capital allocation is what really sets apart companies in this industry. If you think about it, every oil company from a very bird's eye view looks the same, right? They're almost entirely dependent on the price of the commodity and how much it costs to get it out the ground. But the thing that goes into that cost to get it out the ground is how much of it do you need? Where is the demand? How much of it can you get at? And how cheaply can you get that? And a big part of that is production growth and disciplined capital expenditure. Peyto achieved a capital efficiency of 9.7 per flowing BOE last year. Okay. And as we heard through the conference call, 10, I don't know if this is 10,500, maybe. It's something, I don't know what the comma is doing. Okay, it's something we can use in our models going forwards. That the capex is guided at about 475 million in capex, gives us 45,000 barrels of oil equivalent a day of additional production. Considering that Peyto's natural gas production declines about 27%, or 34,000 barrels of oil per day, this should grow production about 10%, which is nice. It's also important to keep track of reserves. Peyto has a 30-year RLI, Reserve Life Index. They don't have to spend for acquisitions for a long time. So they're in a good spot. They're growing, but not dramatically. Different companies have different approaches and different, you'll see different voices in the industry sort of give opinions on approaches. One of the biggest companies in natural gas in Canada, and arguably one of the very best, is Tourmaline. And they are prepared to expand dramatically. They have sort of prepped everything in advance for LNG Canada, and they're ready to just jump, throw up that production growth. Let's get some movement here. That's sort of their mindset. Not everybody loves that. I've seen guys like Eric Nuttall who often talk about the industry and have been super bullish on Canadian natural gas, say negative things about that. They don't love that strategy because they don't think it's necessarily the best way for those companies to increase their profitability. Of course, if you suddenly dramatically increase production and there's only, X amount of increased demand, well, every little bit of production you add is potentially taking away a little bit of profit. Now, that's way too simplistic, right? But some big names who invest a lot of money in the space think that slow and steady wins the race here, and you want slow, steady production growth. You do not want to be in a position where there is, huge expansion right all at once. And a lot of these companies, their asset they own, yeah, you could argue it's not going to be valuable forever, but it's certainly going to be more valuable in the next little bit than it was in the last. And so it's really hard to pick the exact moment that you want it out the ground. And then, okay, how much does it cost? And a lot of thought going into this, a lot of thought. But when you see really good managers like this who allocate capital well, they deserve a premium, to be honest. And Peyto does not trade at one. Their forward PE is somewhere in the range of 7. Think about that, 7. And that's at a price target that's at least $3 over where it is today. So yeah, you get price appreciation. Oh, plus the PE, which currently sits in the low teens, depending on the day, the current PE is going to get slashed in almost half. Crazy, in my opinion. I think it's a crazy opportunity. Costs. Efficiency and cost control are at the core of Peyto, ensuring profitability at almost any gas price. Current operating costs of about 50 cents per million cubic feet equivalent, I assume is what the E is for. $3 a barrel of BOE, barrel of oil equivalent, is among the lowest in the industry. Company expects even lower operating costs due to drilling efficiency, so I'm giving them credit for a few percentage points in my projection. Royalties, of course, expect to be higher with the rising gas price. From 7%, I expect them to pay about 10%. Interest costs would certainly sit about 6.8% of Peyto's $1.35 billion of debt, should decline over time, focused on debt repayment and production growth. Combination of higher production, higher realized price makes the debt less relevant. That should lower the interest costs. Absolutely true. Decisions on how to allocate the free cash flow can change quickly based on how many parameters. I'm going with the current guide of focusing on debt repayment. Makes sense for the company, keeps them for tax reasons. So I believe that when the company reaches below $1 billion, gas strip pricing is still high, they don't have a reason to continue paying down debt. They'd rather switch for more growth or more dividends. So the result, let's see where they're going. Projection, okay. I love they've got the little Peyto logo with a 19% dividend in 2027. I take that. Seriously, Andrew here is doing a really great job. I really do appreciate it. There's a lot of work that's gone into this. I don't know how best to describe just like how much I appreciate that there are fantastic creators out there that give us the opportunity to have these conversations at all. And so just check that out, right? Look at all of this. So you see, you got cash costs in red going into the negative. Funds flow is that yellow dot you see sort of flowing upwards. Free funds flow is the blue dot you get for these next 2 years. And then the dividends, that red dot. So you'll see, the red dot 7.6 and 25, little bit, not even dropped at all, actually, 7.6 again. in 26, and then boom, 19% in 27, continuing to grow 24%, 24% dividend in 2030. Insane. But it makes sense. You look at the way that everything else is playing out in this projection. And again, this is a base case. This is not saying that oil's going anywhere, natural gas is going anywhere fast. This is just saying that Peyto basically keeps things stable, which again, I would consider almost bearish considering all of the positive potential catalysts. Them paying out a 24% dividend is insane. Investors saw a 102% dividend ratio in 2024. Many are afraid about the stability. Now with the hedges in place and much higher gas prices, Peyto's room for significant growth. So your loan, Peyto might be deciding what to do with over $450 million above the growth capex. Believe that 25 and 26 will both be years of focus on debt reduction. 27 is the year where Peyto could give us 19% yield, mostly from dividends. Let's talk about the bear case they've got here. So this is where Henry Hub prices fall below $3 and WTI is at 60. So even lower than today, which again, to sustain that, you would have to see a lot of things go wrong for the industry. In this case, let's just really quickly check that dividend out. Very different story. Like I said earlier, bear case is basically stagnation. Nothing goes anywhere. But even then, you still see the dividend maintain above 7% the whole time. A fantastic dividend. And you're going to see the company continue to grow their sales from operations. They're going to grow their funds flow. It's not that bad. This isn't that bearish. So let's drop down to the bull case, which of course, that's the fun part of this video. That's what I'm excited about, right? And the bull case, this is the, not necessarily pie in the sky, but this is what you want as an investor. Andrew here does not consider it part of the thesis, and it's not the reason you invest in Peyto, but you've already seen much higher prices. So while I don't believe it's a long-term price, there'll most likely be some years with such pricing. Under such pricing, I assume the debt repayments wouldn't be relevant. Change the applicable allocation assumptions to 10% higher capex spending and 100% payout ratio. Further question whether Peyto's future lies in the LNG, hard to answer. They are looking for a deal. LNG brings not only a potential for much higher gains, also potential for large losses if price drop. But look at, okay, so they're setting WTI at $80 across the board. They're setting Henry Hub pricing at $5 for the next year, $6 for the years after that. And in this case, I know this is crazy, but look, that is a 40% dividend. That's a 14% dividend in the next year, which again, double. 23 the year after that, and then we're getting up to a 40% dividend. Can you imagine? Just stop for a second and imagine if there actually was a company that could pay out a 40% dividend. Now, I don't think this will be true. I don't think you'll literally see the dividend payout ratio of 40%. What I think you're really going to see is that your investments made today are going to be paying you out 40% in the next couple of years. Now, I'm going to take it back to the screen here, and I think it's very clear. I align much more with the bull case. I am a bullish investor in natural gas. I think there's huge potential there. I think the bear case for Peyto is stagnation. I think they have demonstrated fantastic ability to not only navigate massive challenges, but not get too drawn in to the potential of higher gas prices. They've navigated all sorts of drops in price. They've navigated the start of this year really well. They've gone through all the tariff drama. They've done a lot of things really well. They've demonstrated really strong capital allocation. They've demonstrated really strong hedging. They've demonstrated the ability to be a fantastic dividend payer. Do they need to spend, 100%? Do they need their payout ratio to be at 100%? Do they need it to be all about the dividend? Absolutely not. There's a million different avenues they could potentially take. But I think functionally, investors today shouldn't be too shocked if they're seeing a 20% yield on cost in the next couple of years. And beyond that, I think you shouldn't be shocked if you see the share price dramatically higher than it is today. I don't understand why this thing is trading at a forward PE of 7. Just to be fair, considering the industry, the opportunity here, I think there's a lot of money that's flowing into this industry. I don't think you're going to see that price for long. It's not very often you see a Canadian company run almost 1,000% in 5 years and still be a bargain. So Peyto is a very special case, and I strongly recommend you check it out, do your research, see if this fits your portfolio, because I think it's a really unique company. I think it's a unique opportunity, and I think right now might be some of the last opportunities we have to get it at such a cheap price. But with that being said, I hope you enjoyed the video. Obviously, super bullish on Peyto over here, but you let me know your thoughts. What do you think about this company? What do you think about their potential? What do you think about the opportunity here? Would love to hear it in the comments down below. And again, if you like this video, you like the kind of stuff we talk about here, please do subscribe to the channel, like the video. It makes a huge difference, doesn't cost anything. With all that being said, I hope I see you in the next one.